At Insightful Value, we dig into companies the market might be misjudging, and today Comcast caught our attention. Yes, the same Comcast that powers millions of internet and cable connections is trading at levels that raise eyebrows. Is this a rare value opportunity or just another media giant getting left behind? This review is for informational and educational purposes only, not financial advice. If you like this kind of real-world stock breakdown, don't forget to hit like and subscribe. So, what's going on with Comcast? The company is one of the largest broadband and cable providers in the United States. It also owns NBC Universal, which includes film studios, television networks, and streaming services like Peacock. This gives Comcast both infrastructure and content, an enviable position in theory. But the stock hasn't been feeling the love lately. Why? The market is concerned about the slow erosion of cable TV, mounting costs in streaming, and weak broadband subscriber growth. In the latest quarter, broadband net adds were basically flat, and Peacock continues to burn through cash as it competes with giants like Netflix and Disney+. At the same time, advertising revenue has been under pressure, which hits both the media and cable segments. From a value perspective, Comcast is now trading at a relatively low price-to-earnings ratio compared to its historical range. The dividend yield sits at around 3%, and the company has a solid track record of annual dividend increases for over a decade. Free cash flow remains strong, even with all the streaming investment, and the company continues to buy back shares aggressively. Operating margins are healthy in the high teens to low 20s range, particularly in the broadband business. Revenue for the full year has stayed stable, with growth in broadband helping offset declines in video and advertising. The theme park segment, yes, Comcast owns Universal theme parks, has actually performed quite well, with international growth and recovery in travel supporting the bottom line. So, should value investors take notice? On one hand, the company is profitable, cash generating, and paying you to wait. On the other hand, long-term cord-cutting trends, fierce competition in streaming, and questions about growth potential raise valid concerns. Comcast has been trying to pivot and diversify, but the market remains skeptical of whether it can successfully transform into a tech-forward media player. The dividend has seen consistent annual growth, with the latest increase keeping pace with inflation. The payout ratio remains below 40%, which gives it room for further increases or protection in tougher times. Could the stock recover? That depends on a few things. First, if broadband growth stabilizes or returns to form, it could restore investor confidence. Second, if Peacock reduces its losses and gains market share, Comcast's media assets may look more appealing. Third, if interest rates start to come down, big dividend payers like Comcast may come back in favor. At Insightful Value, we focus on finding companies that are priced for pessimism but have strong fundamentals underneath. Comcast is exactly the kind of story we break down, clearly without noise and always with the investor in mind. More insights on Comcast and other undervalued companies are waiting for you at insightfulvalue.com. If you enjoyed this video, give it a like, hit subscribe, and stay tuned for more no-hype investment analysis.